Okay, so we're looking at some carrying on, and we're looking really at output VAT. I mean, we know it's 20%. Um, Standard rated at 20, zero rated at 0%. We have to take into account sales that we discount. We'll look at goods for own use. Let's jump into it straight away. We'll look at private fuel. So these are some of the things we're going to look at, and nothing complicated. But as you can imagine, I might imagine if you've done VAT before in some capacity, we only really charge VAT on the actual sale. So you might, if you like, create an invoice and give the opportunity for a discount. If they take that discount, then you have to adjust, if you like, for VAT. The accounting, the double entry itself, it's a bit winded, but it's not difficult at all. It's just we just have to adjust. So for example, let's look at this example. So here we have here that you sell standard goods for 4,000. This time it's excluding VAT. So what you would have done ordinarily if it was including VAT was to take out the VAT and then see what was having to happen. So if the customer doesn't pay in time, it'll just remain at 4,000 times the 20%. But it says here 5% discount is offered if the customer pays within 30 days, assuming the customer does pay within 30 days. So what we now must have, right, is that this product that was once 4,000, what we have to do is to now imagine they take the 5% discount. So in effect, we need to lose 5% of this. So in effect, we need the real cost of the product becomes 95% of this. So in effect, that becomes 4,000 times 0.95, and that's 3,800. So now the real product is worth 3,800, and this is what we now calculate our VAT on. 3,800 times 0.2. So in effect, VAT becomes 0.2 VAT becomes 760. So initially you would have had 4,000 times 0.2, you'd have had 800. And so you would put through an adjustment of £40 in your VAT account. But the question is asking how much VAT should be charged on the sale, and therefore it's 760. So find the initial cost. Remember, this VAT this isn't part of the real cost of the product. That's the real cost of the product, and work from there. Now, the thing with goods for own use is that when someone takes out goods for own use, at the time of purchase, actually, the goods will have a cost amount. But over that time, they might have gone up in value. And in effect, that profit should ordinarily have gone to the business, but it hasn't because you have taken it for your own use. So really, it's as though the business is selling to you, but we must deal with it at the replacement cost of the goods, because in effect you're deprived the business of some profit, if you like, that because really that's profit for the business, that difference between what you initially costed and the replacement cost, if it's higher. Right, so and that's the first thing. So we'll see an example here. But the goods must have been originally purchased for business use, and that's what you will see most of the time. So what we also have here, gifts of inventory, trade samples, we totally exempt, and anything less than, gifts of anything less than £50 in a 12-month period to, if you like, gifts of that sort of that little minor amount, if you like, are exempt as well. I think it's good to see examples straight away so that we can see how this is applied. Right, here we are. So as I was saying here, gift of inventory, so costing £300, but a current replacement cost of 420. So like I say, it's because you are depriving technically HMRC or the business of that profit. So in effect, we base it on the replacement cost. So here the VAT, of course, is 20% of this 420, which takes us to, so this is all output VAT we're dealing with here, 0.2 times 420, which is 0.2 times 420, which is 84. So that is the output payable, so to speak. The business has sold goods to the owner. Has gifted the business has gifted goods, so in effect that's VAT that is due. So here we are, owner, removal of standard goods. Goods originally costed 195, replacement cost of 200. replacement cost of 205. So we deal with it on the basis of the replacement. We deal with it on the basis of the replacement cost, and in effect, what we now have, they're telling us this is inclusive. So really, this 205 is inclusive of the VAT. So 205 is technically 120%. I'm looking for 20%, right? So that's really 205 divided by 1.2 times 0.2, in effect, right? So, or a sixth of that, really, ultimately, which gives us 34. So the relevant VAT here is 34. That's why, so because we're dealing with everything based on the replacement cost. These are gifts of pens, totally relevant. They're less than £50, so it's okay. So there we have that. Now let's move on to the, oops, yes, here we have here. So motor expenses. So here we are. Again, like I say, the focus is on output VAT. In effect, what you have here says a business can recover all its input VAT. So you've bought some VAT. Sorry, the business has bought fuel, which it can. I mean, it's running it for its business. So a business can claim the all the input VAT, if you like, on fuel, no problem. Such as running costs, just fuel and repairs. Even when there is some private use, but it's going to be complicated. But key point is you can claim all the VAT. It's a supply, you are using it, but in effect because you have some private use, well, to a certain extent, some of it is disallowable. You can look at it that way, or you can look at it in terms of you bought this fuel, you claim the VAT, but in effect you've kind of sold some of it privately, if that makes any sense. So it doesn't really matter how you think about it. The key point here is that you're claiming all this VAT on input on fuel that's been bought, but some of it has been used privately. So in effect, you are claiming VAT that you shouldn't be claiming. That's one way of looking at it. And so the question here is, what is the amount we discount, or what is the amount we have sold, and therefore, in effect, have to recognize some output VAT or repayment VAT, if you like, is one way of looking at it. Right, and so it's basically, they give you these scales, but they'll give you in the exam very clearly. So it says here, especially when there is private use. So the key point is, if the driver reimburses the business for the full cost of all private fuel, well, if you like, for the full cost of private fuel, then we're very clear on what the amount of VAT to reimburse is, because we know clearly what the amount is, and then we just return that to HMRC. But if the driver doesn't, then we have a scale. So the full scale is based on the CO2 ratings of the car. Here we are. They'll tell you what it is. CO2 has, here we're given the car's emission 179 grams per kilometer. And assume the VAT is inclusive of these rates. So here we are. It's 351 for car emissions. So this is VAT. It's very separate. They'll give you very clearly. And so this is the VAT. It's typically VAT inclusive. So if it's VAT inclusive, the question here is, what is the relevant VAT related to this? So you have 351 there, and if you have 351, that's VAT included. So that's 120%. So therefore, the VAT, which is the 20% or the 0.2, must be 351 divided by 1.2, all of this times 0.2, in effect, which comes to £58. So yeah, so that's how we deal with this. So you could see this, I think, in a Section 8 question. It's not a bad question, actually, to be very aware. And it's really to do with the fact that a business is claiming all this input VAT, but in effect, some of it is being privately used. So the question is, how accurately can we calculate that private use? And if we cannot, we must use the scales. Cool, great stuff. See you in the next video.